Hey, what's going on, everybody? Steve Peterson with Infinity Investments, and welcome to our channel. And on this channel, we talk about all things commercial and investment real estate. We design content for real estate investors and commercial and investment brokers who are looking to sharpen their axe, gain more perspective about what's going on in the market, and just stay in tune with top quality content. And in today's video, we're going to talk about a couple of tips on finding replacement properties for your 1031 exchange. Now, I just did a video here recently talking about why it's not the end of the world if you have to pay capital gains taxes when you sell your property. So, I want to preface this video with, I truly believe in 1031 exchanges. I've done them my whole career, 17, going on 18 years in commercial real estate. I do believe in them as a great way of building your wealth portfolio. However, I also believe at some point in time, on some occasions, at some times in the market, it's okay, it's not the end of the world to pay capital gains taxes. Now, if you are resolute, if you are dead set on getting an exchange done, there's a couple things you need to understand. And particularly the biggest thing is you need to have a strategy to find the right replacement property. And when I say the right replacement property, I mean basically a better asset. You don't 1031 exchange to defer taxes. You 1031 exchange to find a better asset, and you defer the taxes as the icing on top, okay? So there's 4 key things I'm going to talk to you about in finding that ideal replacement property, okay? Number one is determining your clear investment criteria for that replacement property. And I think that begins with figuring out what your current return on equity is of your existing property, okay? And I've done videos on how to calculate your return on equity. Essentially, you look at your property's net equity, right? That's the value. If you sold your property, that's the dough you have. And you look at your existing, net cash flow. And you compare that net cash flow and divide it by the property's net equity, that's going to get you your return on equity, okay? So now you look and say, well, maybe I'm making 5, 3, whatever, 7% on my equity. So if I'm going to exchange, the only reason that we're doing this is to take that percentage and increase it significantly, okay? Now, by doing that, that then allows you to set your investment criteria for the next property. I cannot tell you how many times clients, we get into a 1031 exchange, we say, hey, this is what we're gonna do. And then the criteria is vague, all right? You don't wanna be vague when you're setting your criteria on this 1031 exchange. You wanna be dialed in and specific to what you want, right? Because, we have time pressures that we're up against when we're doing a 1031 exchange. So you've gotta really dial in and figure out what that investment criteria is gonna be so that you can be selective. Because again, my philosophy that I'm telling you guys is that the whole reason we're doing this exchange is so that you can acquire a better asset, right? So if you're gonna sell this property that you have and that and that maybe you're making a bit of cash flow from, maybe you're not making cash flow from, but if you're gonna sell this property, you wanna get a better deal, and so you gotta know specifically what that is. Also, within that, I think you wanna identify the market that you're gonna play ball in. A lot of people, I'm in the Bay Area, a lot of people are leaving the Bay Area with either they're moving out or they're taking their equity, selling their property and going to another market, which you can make a lot of money in doing that. But I think you really need to, if you're going to do that, you really need to identify the markets that you are going after. And you can do that based on population growth. You can do that based on job growth. You can do that based on just the flavor in the area. If you see there's growth in an area, what you don't want to do is just say, hey, I want to buy something out of state, and just start looking on LoopNet, and you're looking at 10 different states. You're all over the place, and you just going based on what the market cap rate is. If you dial in and say, hey, I want to buy properties in Phoenix, Arizona, I want to buy properties in Austin, Texas, or Memphis, Tennessee, or like for me, we're in the Bay Area, but I like Stockton, California, the Central Valley. Then what you do, you start dialing into that area, okay? But that is all part of selecting that criteria that you do, by the way, before you list the property. Before you even list the property, you spend this time up front figuring out what your return on equity is, figuring out what your desired investment criteria is, and what marketplace you want to zero in on, okay? Point number 1, very, very important, all right? Number two is after you've selected that criteria, after you've been real specific and on purpose with what you want, Now we got to start looking and negotiating for properties as you are listing it and before you are closing it, okay? Once you close escrow, you have 45 calendar days, not 45 business days, not 45 days including Christmas, Thanksgiving or anything else. It's 45 days. And the IRS gave a little bit of a break when we were in the first part of the pandemic. After that, there's no breaks. So there's no, partiality on this. This is 45 days. So the advice here is, as we're going to start looking for this property, we want to do that, as I'm even listing the property for you or another broker, whoever you're working with, you want to start doing that at that time. That's the key time to really dial in. And I think that's important. I can't stress it enough, because that's the point in time where you're going to have the least amount of stress on you. It's as you're listing your property, okay? Now what you can do is really be objective and really scrutinize those properties that are out there. Because as the days go on, and when you eventually close escrow on your down leg property, on the subject property that you're selling, now that every single day that goes by, you're going to feel the stress. You might have $100 million in the bank, but when you're doing that 1031 and that's what you want, there's going to be stress, okay? And like the video I did when I was saying, hey, don't panic if you have to pay capital gains, is because I'd rather see you pay the capital gains than make a bad investment decision, all right? How we can mitigate making that bad investment decision is taking the upfront work and as we're listing the property to find the other building, okay? It starts with point number one, selecting a very clear criteria, marketplace, and then going after it, looking at properties, making offers. And here's the one thing I've heard from clients. Well, look, I don't want to go in and start making offers or something, and I don't even know if my property's sold. Valid concern. I won't dodge around that. Valid concern. But here's the deal. If you saying we're going to do an exchange, we're not just listing your property. We're doing an exchange, which means we're listing your property and we're buying another one. So I understand the hesitation, but we got to just look and say, hey, look, we just got to, every time we make an offer, make it subject to this 1031 exchange. We communicate that to the other side, and we got to go forward. I just bottom line, I think that's what you got to do. Now, you don't want to go hard on your deposit money, meaning non-refundable, until you know your listing is going to be sold. But that's all a factor of negotiations, right? And that's what we're talking about essentially, is looking for another property. We're negotiating for another property once we find something of value. So you want to make sure that you got that locked in, as we're not listing the property we're conducting an exchange, which is listing and finding another property at the same time. Point number two. All right. Now, point number three is you want to look for off-market properties. Now, let me preface this by saying I believe, I'm a bias because I'm a broker, but I also believe that you should be working with a broker in terms of finding off-market properties. Now, you don't have to, a lot of investors, like to do their own thing. A lot of investors are independent, so I definitely can appreciate that. And I'm not saying you have to just be bound to only working with a broker on this stuff, right? But here's the deal. By working with an active broker in the markets that you've selected, they're always going to have something in their pocket that is not necessarily on the market. Because as brokers, as we go through and we're prospecting deals, every property that we put on the market at one point in time was off the market. And there's a process of prospecting and the closing cycle that happens before you bring a property to the market. So you may be talking to a property owner and you're going back and forth doing some numbers, and meanwhile you have this exchange coming up, or somebody reaches out to say, hey, do you have anything coming up? An active broker is always going to have something to talk about to you if you're looking for a replacement property, right? Now, they're also going to have properties where people say, hey, look, I'm not going to list my building, but if you want to make me an offer, feel free. As we as brokers, like the bane of our existence when we're out there prospecting, is because a lot of people, when you're talking to sellers, they say, I don't want to list it. I love the property, but you make me, everything's for sale at the right price, right? So we keep that in the database. When you're doing an exchange, we can go back to these people and see if we can strike a deal. So you want to be looking for off-market properties. I believe you should be working with the broker to do so. Now, some other ways that you can take matters in your own hands. You want to track what's going on in the foreclosure market. You want to track properties that are in default and distress. I use Property Radar for that, which now has a nationwide platform, okay? All states. They used to just be in kind of the western states. But there's a bunch of other databases out there that you can use to track properties that are in default and foreclosure. You also can track properties that are in bankruptcy. If you're following companies, or if you're following what's going on with the property, you see it's in bankruptcy, a great way to kind of reach out to those folks, because 9 times out of 10 in a BK, something's got to be sold, right? So if you can figure that out, and then you can reach out to the lawyers who are handling it and see if they might be open to a sale. That's another great way of finding properties that are maybe delinquent on their taxes, and maybe reaching out to the owners and say, hey, I know you're delinquent on your taxes. Before the tax man gets involved, maybe we can strike a deal. And the last piece I would like to say, and this goes back to, you have to have a selected market, is if you want to spend some dollars like brokers do, we spend dollars on putting mailers out to the market in an area, old school direct mail. Maybe even you can do some ads to property owners and just saying, hey, we're looking for buildings like this. Put your criteria in there. If your building fits this criteria, if you're open to sell, give us a call. It's just a great way for you being proactive and going at that. Yes, of course, you want to check what's on LoopNet. You want to check what's on CoStar, Crexy, all that stuff. But you don't want to depend on that, And I think there's a way you can do this and work with the broker, because when you're doing this is a monumental task. You need a team, all right? A lot of times people say, I don't want to get brokers, I'm going to pay the commission. By the way, on the buy side, when you're buying something, the broker 99 times out of 10, or 99.9 times out of 10, is getting paid from the seller, all right? And if you can find them off market, you can maybe even save the seller some money on commissions, and then make sure your transaction is done right by engaging the right broker, okay? So just don't depend on what's on the market. You got to go after what's off market. And the last piece, point number 4, is consider doing a reverse exchange. Now, reverse exchange is a lot more complicated than a regular exchange. I'm not going to go into the details of it, but if you've got the resources, okay, you got the capital and you got financing resources, what you can do is you can go and buy a property before you sold your property, and then doing it following the guidelines of a reverse exchange, then sell your property and roll those proceeds into the property that you bought first. Very complex though, very complex, very complicated, very expensive way of doing it, and it requires you to have some resources up front to make it happen. But for those of you who may have those resources, because here's the deal. The exchange process brings us all, whether you're 100 million, a billionaire, you're a beginning investor, you got one property, it brings us all to the same 45 days to identify, to the same 180 days to close escrow. It doesn't matter how much money you got, right? So if you have resources and capital and a bunch of financing options, a reverse exchange could work for you because you got the same problems as the beginning investor has, and it just kind of mitigates that that time process, and so won't go too much in that, but I just wanted to put that out there as an option for you guys who out there who do have resources to try to make something happen. The bottom line is this, guys: if you're going to do this exchange process, when you sell your property, attack it up front. Have a plan, have a team, go after it. Don't just think, I'm going to sell this property and I'll find something over there, okay? Because then you get stuck and it's a stressful process for everyone, by the way. And then a lot of times you're not going to find that ideal replacement property. Remember, the point of doing an exchange is to find a better asset. The deferral of capital gains is the icing on the cake, baby, and this is why we love real estate. And if you watch my video on why paying capital gains is not the worst thing, I'd rather see you pay the capital gains than buy a bad deal, all right? Just, because we want to be doing business a long time, and I think that if you're working with another broker who is of the same mind, they're going to see things the same way, but they're going to work their butt off if you tell them to find me a replacement property to then find that property. Hope this helps. If it does, like this video, subscribe to the channel. We're going to continue with content like this, and let's just keep continuing sharpening our axe and raising the bar in the commercial investment real estate world. Peace out, y'all.